Hello everyone, welcome to Fearfully Greedy. In today's video, I will show you the new format and the last 60 companies I looked at, and then the one I inspired me more curiosity. Let's put it like that. The portfolio as of 19th of August, it's like this. We're up over 30,000 euros. It's harder and harder, let's say, to keep a straight face when making these videos because at this point Carvana is like 50% yeah, of the portfolio. So yeah, it's become a meme portfolio, so I'm sorry. But remember, this was a 2,000 euro purchase, which just has skyrocketed, and it's 16 times original money. Keep in mind, you can keep track of the portfolio just subscribing to the YouTube channel. If not, there's a link in the description where there's a Google Sheets where I update more frequently. Like, I always update everything in the YouTube channel, but there, in between videos, I also update, okay? Disclaimer, these and all my videos are not to be considered financial advice. Please consult a professional or do your own research before investing. I also may hold positions in all the discussed stocks. Take that into consideration. Okay, this will be the setup. There will be pass and investable companies and 3 different levels on each side. I looked at 60 companies and 7 of them I just didn't like. It's just that I saw the business model and I said, well, there are some things here that I really don't like. Then the too hard is just that my thick skull, I cannot get the idea through. I just don't know what this company will look like in 10 years. I have no idea why this is more competitive than someone else, why there's not a newcomer that is taking all their business. So this is what too hard implies. Like, I just cannot wrap my brain around it. The too risky is just that maybe I like the company, maybe I understand it, but also it has too much debt, or they just have one customer, or I see that they are one coin toss away of not having any business. Okay, then things that are okay is that, okay, I understand the business. I think it's not bad. It's okay. I cannot say like I love it, but I would put it on a 6 on the scale. Like, I'd say it's a good business. It's okay. Then that I like, it's companies that I think they are good business models, and there are some things that I like. They don't get to the love level, but still there's a lot of things that I like. If you see there, it's like the second biggest bucket of all of them, and that's because these are not just random companies in the stock exchange. These come from Value Investors Club ideas, or good investors portfolios, or like friends ideas or something. Then see what I loved. I found no love in these 60 companies. Oh, bummer. But 32 of them I passed, 28 of them I deemed as investable, and I take all of these and I have them on a Google Sheet. But let's look at what is investable. I will rank it as it's below what I think it's worth. It's between what it's worth and double that. It's at least double or a triple, or it's more than that. So let's see how they fare. I tried to make it like exact on the graph, but I will do a better job next time. But I just make them fit in the right quadrants. Okay. What I mean with this is that I would like to see things that I love and that are fair. That would be a good place to look at. That I love, but I think they are moderately cheap, like underpriced, that are at least a double up to a triple that I love. And my favorite would be that they are super cheap. I also love the company, which rarely I find anything here. All these quadrants would be my ideal choices, but rarely we will get here. Okay, let's look at the thing that I like the most, okay, or that piqued my curiosity the most. I'm not saying I will invest in this, but it piqued my my curiosity, and I think following curiosity is important here. I think gut is an important thing in investing. Then after this, once curiosity has sparked in you, then checklist and due diligence and other things are also key. But curiosity is something, it always starts here, curiosity. This is a company, Li Auto, that is based in China, Beijing, and it's trading at $20 billion market cap, and they are a car manufacturer. Okay, what else is about Li Auto? It's founded by Liang Li, okay, which is the founder, the chairman, and the CEO. Up until now, they were 100% extended range electric vehicles in China, which we'll get into what that means. They have exploded in sales in the last years, and Liang still holds 21% of the company. Okay, so he's a billionaire at this point. Okay, as of June 2024, the company has 497 retail stores, so they do some direct sales. They have servicing centers, and they have body shops and operate, like they even have supercharging stations, but they have like a direct to market kind of setup. Li Auto, probably some partners also, but kind of direct. Okay, first let's take a look what an extended range electric vehicle is. It's like a normal electric vehicle that has an internal combustion engine, which is powered with gas, right? And this powers the battery and powers the motor, the electric engine, right? Mostly it charges the battery, and that battery charges the electric engine. That's what I gathered. If you have more information, we could go deeper into that. Let me know. I think it's an hybrid, but which makes more sense. Like this engine is more thought to not power the vehicle, it's just to power the battery. So you have like 1,000 kilometer range, but it's still electric vehicle. And this battery is like a smaller size than the same size vehicle would have in a battery electric vehicle. Okay, I found this study that will show some light into that. There are more studies, but I like this one because it's based in China, and this company sells only in China. So I think it's a good article. I will link it in the description. But optimal vehicle size and driving condition for extended range electric vehicles in China, a life cycle perspective. Okay, first conclusion that they got into: for extended range electric vehicles, the mineral resources are mostly consumed at the raw material acquisition stage. Okay, stage 1, it's the raw material acquisition stage. Stage 2 is building the vehicle. Stage 3 is operating the vehicle. Stage 4 is recycling the vehicle, and this will be the total number. Here we're checking at energy consumption in millijoules and by substrate. Okay, which this is important, but what we want to see is that this would be energy. Okay, of course, by operating the vehicle you get a lot of that, and you get some of it back, right? And this would be energy consumption to source the minerals. This is to construct the vehicle. Okay, if we take a look at mineral consumption resources, if you see the biggest bucket is when you make the vehicle. In battery electric vehicles, that's also the case, as we will see, and you get kind of a lot back when you recycle the vehicle properly. And in China you do that, so they have a lot of recycling, so it's not that bad. And the main difference would be the consumption. Okay, and some of it is lost, right? You use some energy to use some minerals to get the minerals back. Okay, number 2, for all other vehicle types, that's also the case. Like the mineral resources is mainly consumed at the raw materials acquisition stage, and the recycling of vehicle is important for saving mineral resources and reducing the environmental impact. Okay, so we see the blue, which is phase 1, is the biggest in all of them. Depending on what kind of vehicle, you get more back in the 4th stage. And if you see in China, think about it, it's in China, so their electric powering is still kind of dirty still, so they have a lot of coal and other things, so that's why it's more or less the same across the board, right? But if you see extended range, they have a lot of it back. Battery electric vehicles, they get less back, but they also spend less on top, right, on the sourcing of the materials, probably because they only have one engine, right? And this would be hybrids, this will be plug-in hybrids, and these fuel cell electric vehicles, which will be hydrogen, and ICEV would be internal combustion engine vehicles. Okay, so traditional. And here we'll take a look at ADP-E, which will be more like resources, mineral resource depletion, and ADP-F, okay, which will be fossil energy depletion potential. Okay, let's take a look. We just saw elements, so minerals. Okay, if we take energy, so fossil fuels, we can see that some of the worst in China is battery electric vehicles. That's because just to make the battery, you get a big cost, but also the electricity that you use, it's also dirty. So sure, this is dirtier, right, in internal combustion engines, but you also spend less. Also, you spend less to construct it. Also, you didn't get much back, right? But take a look and just think for yourself, okay? But this would be like middle of the road extender range, where hybrid, you get the two engines. It's more traditional, but you can use some electric, but electric is also dirtier, as it happens in China. Okay, the third conclusion they got is that in general the mineral resource consumption increases with the increase of vehicle size, because that's what the other part of the study, that they wanted to see what side of vehicles, if passenger, light trucks, or heavy trucks, would make more sense for each one of the technologies. Fuel cell vehicles consume the most mineral resources. That's across the board, right? Fuel cell hydrogen, that's because you can recycle very little of it, okay? And ICE, so internal combustion engine, is always remains relatively low. That's to make the car, right? So yeah, it's pretty low from the start, always, right? Now we'll take a look at consumption of the energy. However, among the vehicle of the same size, ICE has the highest fossil energy consumption, as we can see here. Okay, has the highest energy consumption, and VIEs has the least fossil energy consumption. So once you have the car, okay, once it's made, if we forget how we made it and we forget how it will be recycled, hydrogen is the lowest one in China. Okay, what I want to also tell you is that if we make cleaner electricity, this one will be the best. Okay, together with this, that this will also be the best in the previous slide if we make better recycling of everything. Okay, just something to keep into perspective, that not IC is the worst and BEV is the best. The fourth one is that driving conditions, okay, where you are driving the car matters also. So this, irrespective of size, they in the study they show you what cars and kind of the characteristics of the cars. The urban driving conditions are superior to the combined condition and suburban condition across the board. Okay, so the urban, which would be the yellow one, always consumes more than the combined, and suburban, outside of the city, it's always the best, right, across the board. For ICEV, so internal combustion engines, the fossil energy consumption under the urban condition is 29 to 53% higher than under the combined condition. What that does mean, okay, that for internal combustion engines, urban is pretty bad, suburban is one of the best, right, compared to the 100%. Each one technology has their own 100%, so these are not scaled. So 100% just between these three lines, 100% between these three lines. Battery electric vehicle has the lowest difference. So if you see BEV, they still packed, but if we do extended range electric vehicles, they have the lowest compared to the 100% which we combined, and it doesn't skyrocket a lot in the urban one. Okay, so what does it mean? That if you do suburban, extended range makes sense, internal combustion engine makes sense, If you are urban, hybrid makes sense. BEV, so battery electric, normal electric cars makes sense. Extended range also makes sense. So it's kind of, it makes sense in more places, let's say. If you do mostly urban, what is your best? Hybrid or battery electric, okay? ICV, plug-in and extended range have more obvious difference in the environmental impact under different driving conditions, okay? So there's wider difference depending where you drive. If you do more suburban, you are farther from the city and you'll drive more constant, extended range seems to be the best option. And that's what we can get. If energy gets cleaner, electricity gets cleaner in China, probably BEV is better across the board. But still, if your range to your city is not long and you drive mostly outside the city until you get to your work, extended range can be also very clean because you do mostly electric until you get there, mostly electric until you get back, and you're having an electric car. And when you're gonna go for the vacations, you don't have the anxiety of the low range, or because that range, everything that is advertised is always wrong. It's always super optimistic, and then you go into a lot of anxiety. In our home, we have an electric vehicle, and it's like close to 10-year-old at this point. The battery has been changed, but it gives you anxiety a lot of the times when you have to go somewhere. You're always thinking, okay, where is the next charging station? Can I go and back and be relaxed with it? With the extended range, you really don't have to worry too much, because once the fossil fuel, let's say, engine kicks in, you still have a lot of range until there, and you're just, okay, you're making a bit more pollution, but it gets you there. Okay, let's get back to Li Auto. Li Auto sparked my interest because if we take a look at all the manufacturers from China, we can see Legacy, I think Legacy also, and there are some new players, which would be this, and BYD. BYD, we know it, like it's the best. I won't argue with that. It's the best, and also it's not priced so bad, really. But by revenues, Li Auto is already 5th in all China sales, right? We don't know Tesla. Tesla is not here, but Tesla is a bit bigger than Li Auto, I think, so might fit here. But yeah, it's 5th already from the new players. Also, this, when they started, Neo, Li Auto, and Xpeng, they were together, like they were starting from the same place, from zero. Now, Li Auto has picked up, probably because hybrids have picked, and they are not like real electric vehicles because they have an internal combustion engine. But okay, let's just check out operating margins. Best one, BYD. Great Wall Motor is still very good. SAIC Motor Company is state-owned, so it's owned by the government. And Li Auto, for a company that's 4 years old in car manufacturing, it's pretty ridiculous. Like, they have very good margins, as we'll see in a second. And it's the cheapest. It's one of the cheapest. We can look at it, and it's the highest growing. So that's what I think. And the bank is big, and now it's not shrinking anymore. It's growing. So not bad. So that's what piqued up my curiosity. Okay, let's speed this up a bit. But if we take a look at NIO, okay, at gross they make a bit more, but everything else, they are burning a lot of cash. The cash position is not ridiculously big. Here it says that they are losing 40% of their revenue, so 40% of this is like 20 billion. They have an extra year, so we'll probably get, either they grow a lot revenues or they will need external funding. NIO. Xpeng, it's growing more, but the cash burn is pretty intense also. So 30% of this revenue is like 10 billion, so that they have a bit longer runway, but they are burning cash still at these moments. And they need to grow, keep this up, like keep growing a lot, and the base is lower at the moment. But if we take a look at Li Auto, it's a different beast. It's a completely different numbers, right? That's what I look to me. It's not burning cash anymore. Growth is ridiculous. Growth is bigger than the other two newcomers, like newcomers, and they have a lot of cash. I don't know. The reviews online seem crazy good. The cars look like trash, in my honest opinion. But I think this looks very different than the other two. That's what I think. If we look at the BYD is already making a lot of money and will probably keep doing a lot of money, and it's growing crazy. Like it's still growing like a lot, okay? And they have a big pile of cash. They don't owe anything, so BYD is top of the pack, but it's also priced for China pretty rich, like 20 times earnings, 22 times next year. Cash flow a bit less, right? EBITDA, if we go by bullshit earnings, it's looking better. But yeah, BYD is a bit more expensive. If we take a look at Li Auto, it's priced a bit over half, so it's half price, a bit over that. Okay, this is their bread and butter. Okay, what they have grown a lot in sales with is you have these 36 kilowatt hour batteries, which will be like 5-year-olds entry-level batteries size, right? But then they have this 4-cylinder internal combustion engine that powers these batteries, and then the electric engines power the traction. But look at this range. This is in kilometers. This is ridiculous. And with electric, let's say you do 180 kilometers. That's for most people in China. That gets you to your job, I think. But I don't know. And then they have pretty fast 20 to 80% charging capacity, right? And what is new is that now they have the Mega, which is more expensive, but it's a six people car. It's full electric, so it's their first full electric car, and the battery is like the biggest Tesla battery at the moment. They have according to them, the fastest charging registered power at the moment. So the 5C peak charging rate, 520 kilowatts, it means 500 kilometers of range in 12 minutes, which is ridiculous. Probably not very healthy for the battery. And yeah, so this just came up. So this is new from 2024, okay? But for now, only in China. Soon maybe in other countries, but okay. And 5.5 seconds it goes to 100 kilometers, which is pretty high acceleration for this car. Something that came to my mind is that aren't they having a problem with natality in China? Aren't they like not getting a lot of kids now? Same as in Europe. Like, I'm not saying we are doing any better, but who will you feed these huge cars with? Like, to me it sounds counterintuitive. Probably with your friends, so it sounds good. Probably you get your friends in. But yeah, it doesn't make a lot of sense, this huge lot of kids in your cars, which is most of their advertisement. Another thing to keep in mind, it's an ADR buy structure, so keep in mind we have not really tested this. Like, if things go very south, we don't know what we really own. Keep in mind always that when we buy an ADR, which I own some, so we'll see, but something to keep in mind. I wouldn't like to have all my net worth in these structures. I don't think they are as solid as Western structures. And another thing that popped in my mind, we'll go into the P&L. Okay, we have 26 billion RMB, 44 billion RMB, 120 billion, so this 21, 22, 23, which is like 16 billion, 17 billion RMB, and they are a bit over that if we do TTM, trailing 12 months, okay? Of these, for 120 billion in sales, 123 billion in sales, we spent 26 billion just in parts and making the cars. 96 billion, which gives us 27 billion gross profit. That's 22%, roughly. 20% here, 21%, so it's pretty constant. I'd like to find consistency, because when I see an odd number, which is where we will get into, some odd numbers come up sometimes. But yeah, you spend half of that profit, 10 billion in research, 10 billion in selling it. So spending 10 billion to sell 120 in cars, that's pretty good. They have this direct sales model. But yeah, operating expenses, it's around 20 billion, which gives us this 7 billion in profit. Since they have a pile of cash, they also are getting some interest income. Total, we get down to net income, okay, 11 billion. Okay, what I want to get into is that, okay, we have 11 billion, but in cash flow operating activity, we have 50. What's that? Okay, let's take a look. What is the big item? We see this. Okay, trade and notes payable. What that means is that in the account liabilities, okay, the trade and notes payable, it has skyrocketed in the 2023, and it is still elevated, which probably they have renegotiated with their providers, their manufacturers, their providers. They have renegotiated, or yeah, they are paying later, or they are just having trouble paying them. I don't think it's that. It's just they renegotiated. Also, volumes have increased a lot, but this level of jump is pretty big. So it is not real cash flow. So if you saw very big free cash flow, it comes from this. This should be like more like 50. 50, it's more like it would make more sense. So probably the cash will go down. This, keep in mind, it's $7 billion at the time of reporting. Okay, so this should be a bit less. Okay, in the end, to summarize, it's a enterprise value. You're paying 10 billion for this. You have operating income at the moment in dollars, 1 billion. So 10 times, 7 times, 8 times, depends what multiple what you're looking at for $18 billion. It's a company that's growing a lot. Probably will have its top of the segment in profitability. Very clean, very big, very good financial position at the moment. Management, I don't know. This is later in my research. I'm not investing in this company. Keep that in mind. I just want to show you what seemed interesting to me. We're not getting very diluted at the moment in the company. Growth is ridiculous. And if I estimate the value, taking into account the cash position and everything, being a bit generous maybe with the valuation, I would say this is roughly worth $40 a share. Keep in mind, it's China, high risk, car manufacturing, which would be maybe second to aviation into bad ideas for investors. But yeah, margin of safety is around, I think it's worth around double what's currently trading at. Okay, that's it. I will look at more companies. I will keep my mind open and come back with you with this model of showing you everything I looked at and maybe the most interesting idea for the last weeks. Okay, don't expect a video every week, but I will try to be more constant. So since the last video I traded some, I bought 2,000 shares of Pax, which increased my position by 25%. It's trading at all-time lows almost, so 4.14 Hong Kong dollars. If you see, this has brought my average break-even price a bit higher, but we're still under the water, let's say. And I think, yeah, the company is taking a bit of a flat year. They are not meeting like their guidance, so it looks red in the market, but that's when you want to buy. Okay, the portfolio sits like this at the moment. I will try to keep this more constant. Well, everyone, take care, be safe, bye bye.